Good morning, everyone. Thanks for joining us today. We're super excited to talk to you guys about this process and hopefully answer any questions that you may have about buying a home. I'm not sure. I only know Kathy, but basically I'm born and raised in Rehoboth Beach, Delaware. My parents have been here for over 30 years. I grew up in the restaurant industry. When they moved here 30 years ago, they started a restaurant, sold it in '04, but have stayed in the restaurant industry since. So I am familiar with the industry that you guys work in, all that good stuff. And I started in the mortgage industry in 2020 and have loved it ever since. It's been great. Yeah.
I'm Nick Robertson. Me and Cecilia are partners in business and also in life. So we were working out of our home pretty much every day. Been in mortgage since 2020 as well. I also came up in the restaurant industry. I didn't get started quite as young as Cecilia, but around 18, all through college and after college, I was working in restaurants around where I went to school. Cecilia and I she moved back, brought me with her January of last year. And every once in a while, you'll catch us pulling shifts at Inloop and City Oyster House as well when we're not doing mortgages. So I'm excited to chat with you guys today. And if anybody has any questions as we go through any of this, feel free to, put it in the chat or just stop us and ask your question as we go. So we'll jump right into it.
So just getting started. So where do you start? Usually people reach out to real estate agents first when they start to consider buying a home, when really the first person you should call should really be a loan officer, because many of the best real estate agents won't even take you to look at homes if you haven't spoken to a loan officer first. So what does a loan officer do? We determine your current credit score for mortgage financing. We establish a target payment and associated sale price for the qualification purposes, so basically what you can qualify for. We help you understand the documents that need to qualify for a mortgage, and we discuss your loan options because there are so many different products that can pertain to anybody. And we also help you obtain a pre-approval letter from us. So with these bullet points, they're also going to cover the main topics that we're going to go over with you today. There you go.
So let's talk about credit. Credit is kind of one of those things that everybody has to live by, but not a whole lot of people understand. I can speak for at least Cecilia and I. We both didn't really fully understand how a credit score worked or what went into a credit score, prior to being in this industry. So we definitely don't blame people for kind of coming into this without either knowing what their credit score is or knowing how their credit score is determined. So that's how we're going to get started, because it's a big part of, when you go to finance anything, especially a home. So as you can see here, there's kind of two large sections of this pie chart that make up a majority of it, and that is your payment history and the amount owed, or not just amount owed, but it's a percentage of what you owe versus your limit. So a general rule of thumb is to try and keep your balances under 50% of whatever your credit limit is. So if you've got a credit card that has a $4,000 limit, it is ideal to try and keep that under $2,000, every month on the statement, at worst. And if you can keep it under 30%, that's even better. You will see, let's say if you've got, some balances that are over that 50% mark, if you can get them under 50, you'll see a pretty dramatic improvement in your credit score. And then same goes for if you can get it under 30%, you'll see an even bigger jump up. So if, credit score is something that you're trying to work on, or something that, you want to set a goal for yourself, those percentages are kind of good targets to, set goals for yourselves as you're trying to pay down balances. What else? A couple of other things. Length of credit history is the next largest chunk. And obviously this one is kind of hard for anybody to work on. This is just something that kind of comes with the territory. It's unfortunate that it weighs so much because, especially in this industry, there's a lot of younger people, and having a shorter credit history definitely has an impact, as you can see. But that being said, every year that you have, credit lines open, that just kind of continues to help you as you leave them open. So that being said, even if you are able to pay balances down in full, we definitely don't recommend closing credit cards if you pay them off. Just don't use them. You want to cut them up, that's totally fine. But leaving those accounts open, especially if you're a younger person or have a shorter amount of credit history, having those accounts open with low balances will definitely help your credit score. So we don't want anybody to close accounts after they pay them off. And then the last couple of things here: new credit, and then types of credit in use. So with new credit, essentially every time you open a new credit account, there will be, initially a slight hit to your credit more times than not. So, trying to avoid opening a lot of new credit all at once will definitely help you in the long run. Although if you were to open a couple of accounts at once, you would see an initial drop in your score. Eventually that would climb back, so long as you don't continue to keep opening new accounts. Go to the next one, please. Here's a couple of just tips. We kind of covered a couple of these, but just overarching tips to help you keep your credit score high or help improve your credit if that's something you want to improve upon. First one, monitor your credit. So we have here annualcreditreport.com. I think the parameters around this are that you can check this for free. I believe it's once a year. I'm honestly not super well versed in annualcreditreport.com. I typically recommend to people, well, let me back up a little bit. One of the reasons is there are actually lots of different kinds of credit scores out there. So there are about 40 to 50 different algorithms. And depending on what kind of financing you're looking for, whether that be you're looking to finance a car, you're looking to get a new credit card, or you're trying to get a mortgage, each of those lenders are going to look at a different algorithm to help make their determination on your credit worthiness. So just because the Credit Karma account that you have or the app you have on your phone, Experian app or whatever, says one credit score, that doesn't necessarily mean that that's going to be your credit score when you go to finance a home or finance a house, a car or anything else. That's just one particular algorithm that they're looking at. So what we typically recommend, there's another website out there. It's called myfico.com, myfico.com. This website, we're not sponsored or have any kind of affiliation with them, but I've found that it is the most accurate when you're trying to determine what your credit score is for a mortgage. There is a mortgage-specific credit score that almost all lenders out there will be looking at when they pull your credit for a mortgage. And this website, myfico.com, will give you that actual score. So if you're curious about what your credit score may be before you go to get pre-approved for a home, which we'll talk about shortly, that's a great resource. It is not free, unfortunately, so it's a subscription-based service. I think they charge like $40 a month. What I tell people to do is, if you're working on your credit or you want to check it before you have your credit pulled by a lender, just subscribe for the first month, pay that $40 one time, and then cancel it immediately. If you're somebody that wants to improve your credit, there are a lot of great tools on that site. So if you wanted to subscribe and continue to keep it running for the next couple of months or whatever, there are a lot of tools there to help you continue to monitor it and work on it. But if you're really just looking to find out what your score is, you can always cancel it immediately after you get the information you need. Next couple of things, obviously pay all your bills on time or early. I can speak from experience and seeing this happen to other people on their credit reports, but even one late payment on a credit card bill, or one late, even one 30-day late on a car or something like that, will have a dramatic impact on your credit score. It's not something that you can't, recover from and fix, but it will definitely have a large impact when it first happens. So obviously pay your bills on time. Don't co-sign loans. So that's obviously kind of an overarching, we're not going to say never co-sign on a loan, but it's more just general advice to know that if you do co-sign on a loan and the person that you're co-signing for decides to miss a payment or just forgets or whatever, that will have an impact on your own credit score as well. So we like to remind people of that. Don't close old revolving accounts. We just spoke about that. So, closing an account will have a larger negative impact than just leaving it open and no balance. So keep those accounts open, especially if you have young, fresh credit. Don't open new accounts unless absolutely necessary. So kind of going back to opening that 10% of, opening new accounts. Again, open them if they're necessary. If you need a new line of credit for any reason, definitely an option you should weigh, but just keep in mind the more accounts you open within a short amount of time can start to negatively impact you. And then obviously, if you notice any fraud on any of your credit lines, report that immediately. We were actually just talking to a borrower like 2 weeks ago that was looking to get pre-qualified, and they had a decent credit score, but they could have had an even better credit score. Unfortunately, they did not catch fraud on time, and they had a large balance get drawn, on one of their lines of credit. He didn't notice it for like a month, and all of a sudden he had this like $5,000 balance on a card that he didn't know where it came from. And it's been several months since that happened, and he's taken steps to try and remedy it. But if you're not paying close attention to those accounts and you let it slide for a little bit too long, it can be much harder to deal with down the line. And then the last thing, do not extend or open new credit accounts while in the mortgage application process when you're purchasing or refinancing. So when you go to apply for a mortgage, that basically opens up a whole process. And when you're in that process of buying a home, let's say, we pull your credit and you get pre-qualified and you get an offer accepted on a home, and, we get a week out from your closing date, you're almost ready, you're going to sign the papers and take the keys to your new home. And what we do is, and what all lenders do, it's called a soft credit pull. So basically they take another quick glance at your credit, and if you've opened any new accounts or you've, increased your balances by a whole lot in that short time span between you first got your credit score pulled and, right when you go to close, that can have, some serious implications and can delay your closing or even, change, how much you qualify for, which is obviously not great. So we always recommend to people, if you're serious about buying a home and you've put an offer in or you've gotten pre-qualified, do your best to kind of leave the balances as is. Don't open any new lines of credit.
Don't buy a car.
Yeah, we've had people, had somebody buy a car 2 weeks before they close, had somebody buy a boat a week before they close.
New furniture for the house. Just don't do it. Do it after you close.
Cece, do you want to run through these?
Yeah, of course. So just the 5 credit myths that, there's a ton, but most of them that we come across, it's paying off and closing out credit card will increase your score. Nick went over that. It won't. So don't do that. Pay it off, but just don't touch the card. Don't close it out. Keep it as is. Keep it open. Paying a collection will raise the score immediately. Also not true. Paying off an auto loan or a student loan will improve your score. All debt isn't bad debt. So if you have a little bit of the debt, it's totally fine. We also take that into account, that it is an auto loan or a student loan. Those are reoccurring. You know how much the payments are. It's not like you're jacking up your credit cards, Opening a new account will hurt your score. That's not totally true. Just depends on what you're opening for.
Mm-hmm.
And then having too much credit available hurts your score. Also not true. Again, just depends on how you're using it, if you have, done your 30% or less. And
mm-hmm.
So
generally having more credit lines available to you will help your score so long as you're not constantly reapplying for new credit. But if you have, 2 or 3 credit cards and, every 6 months, every year, they send you a notice, hey, your limit has increased. You have now this much available to you in credit.
It really just shows that you're a good borrower.
Right. Now, don't go and, max it out and take all the credit they're going to give it to you. But don't feel like just because they're giving you an increase in your limit, that's going to impact your score. Generally, it will actually help you as long as you don't increase that balance. So going into it, a lot of people, obviously, mortgage, buying a house, this is a big reason why we're doing this presentation right now. Nobody's taught this stuff in school. There's no course on how to buy a house. There's no course on even credit and mortgage and lines of credit. So this is kind of really basic, but it's something that we like to cover just because, again, it's not something that we're taught. So obviously the principal and interest is a large part of what goes into a mortgage. That's what most people think of when they think of a mortgage payment, principal being however much you borrowed, and then the interest that you pay on the amount that you borrowed. But there are also a few other obligations that you have when you buy a home. You can't just make the principal and interest payments on your mortgage and think that, that's the only payments that go into it. And also, you're obligated to make these other payments. So you can lose your home if you don't make payments on this stuff, or you can get into, some trouble if you don't make your payments on taxes and insurance. So taxes, obviously, here in Delaware, it's one of the many reasons why people are moving here in droves, is because the property taxes here are relatively low to many of the states in our area, or honestly in the whole country. They're some of the lowest. So that's nice. We have that going for us, but I would be remiss if I didn't bring up transfer taxes. So here in Delaware, transfer taxes are something that everybody has to go through whenever you buy or sell a home. It's a 4% transfer tax. So essentially, if you are a buyer, you're going to split that with the seller. So it's 4% assessed on the total purchase price of the home. And then it is split evenly, 2% for each side. And that is part of your closing costs. Now, if you're a first-time home buyer, there are, in many instances, ways for you to get a reduced amount of transfer tax assessed to you as the buyer. So it changes depending on what city or municipality you're in. So it's not across the board. There is a portion of the state transfer tax that everybody gets off. So no matter what, if you're a first-time home buyer in Delaware, you buy a Delaware property, you will get a slightly lower transfer tax than somebody that's not a first-time home buyer, no matter what. And then as long as you're not in a specific few municipalities, I know like parts of Wilmington, some parts of I know Millsboro is one of them, but only specific parts of Millsboro, you will even get a further reduced transfer tax. So that is one of the many great benefits of being a first-time home buyer, is you get to take advantage of those tax credits. And they're not even credits. It's not like you're going to get a rebate after you close. They actually, you just pay less at the closing table. So that's nice. Insurance. So that's another piece of your monthly payment. So homeowners insurance is something that everybody has to have if you're financing a home. Homeowners insurance can vary drastically depending on how much coverage you may need, where the property is located, what kind of property it is. But it's not something that necessarily has to be really expensive. I would say a majority of the insurance bills that we see, range anywhere from $80 to like $150 for a typical, cost of a home.
And it falls off.
Yeah, well, no, that's mortgage insurance. So mortgage insurance is another piece of the pie, so to speak. So if you put less than 20% down, and we'll cover this a little bit more in depth, I think, later on, but mortgage insurance is something that everybody is obligated to pay so long as you put less than 20% down on the home. This is kind of where, if you've ever heard, especially the older generation will say, you need to put 20% down. That's the only option. If you've heard this myth that you have to put 20% down, this is where it comes from. I would say it was, I think, in the 80s when they came up with private mortgage insurance, this idea that you could put less than 20% down, but then you would have this additional monthly payment to kind of help shield the lender in case you were to default on the loan because you didn't put 20% down. When it first was invented, mortgage insurance was crazy expensive. So that's kind of where this myth came from, that you need to put 20% down because you're wasting all this money on this mortgage insurance that you could just save and put into the down payment. However, it's changed a lot since it was invented. Mortgage insurance has become 9.9 times out of 10 very reasonably priced. And as Cecilia mentioned, it falls off after you reach 20% equity. So we'll cover equity here in a little bit, but essentially what happens is you make these monthly payments of mortgage insurance in addition to principal, interest, taxes, and your homeowner's insurance. And once you reach 20% equity, that payment falls off. Again, these mortgage insurance payments, they depend on the value of the home, the type of property, your credit worthiness as a borrower. So your credit score does impact how much you pay in mortgage insurance as well. But it can range anywhere from $50 a month to, I've seen upwards of $200 a month. So it really depends on your individual situation. But again, if it's $100 a month, it typically will fall off in 4 to 5 years. So 5 years, 60 months. If it's $100 a month, that's $6,000. $6,000 compared to maybe bringing another 10, 15% to your down payment. I mean, the difference between 5% down and 20% down on an average home is tens of thousands of dollars. I mean, on an average priced home, you're looking at, $60,000 to $80,000 more, as opposed to making these mortgage insurance payments of $100 a month proposed. And, in the long run, you're saving a good amount of money. So we are big proponents of mortgage insurance, especially in today's economy. We know it's really hard to save 20%. It's not realistic for most people. So while it is this additional monthly payment you have to make, in the long run, it can actually be a lot, better for you financially, to just make that additional payment instead of trying to save additional tens of thousands of dollars.
More cash in your pocket too.
Yeah, even if you have the money to put 20% down, maybe you would rather leave that in the stock market, where you can get an 8 to 10% return every year, and just use that money to continue working for itself, and just make those mortgage insurance payments, because again, it does eventually fall off, usually in a quick amount of time. And then the last piece of a mortgage, not necessarily part of your monthly payment, but it's what we call cash to close. So a mortgage truly is just cash to close and then your monthly payment. So the first 4 things we covered are the monthly payment piece, cash to close being your down payment, which, a lot of people, that's kind of a basic. A lot of people understand down payment, but then also closing costs as well. So with closing costs, what we generally tell first-time home buyers, or really any home buyer in Delaware, is you can expect somewhere in the ballpark of 2 to 3%, plus the transfer tax. So if you factor in a full 2% transfer tax, you can expect 3 to 5% of the total purchase price to be the cost, the price of your closing costs. So if you're looking for a way to help you determine how much you may need to save to buy a home, just do whatever that purchase price is of the home, take 5% of that. That would be at the absolute highest end. It's probably going to be closer to 3 or 4%. That would be your closing costs, and then you add your down payment to on top of that. So first-time home buyers, you can generally get away with 3 to 3.5%. Add that to your closing costs of 4 to 5%. So what I generally tell people is you are typically looking anywhere from 7% of the purchase price to 10% of the purchase price being your total cash to close figure. So when people are out house hunting, you're trying to figure out, how much do I need to save, or how much should I, expect to, try to come up with by closing, or by the time I go to apply for a mortgage. There's some kind of figures for you to do that math ahead of time. You want to run through this?
Yeah. So what's equity? So basically in real estate, equity is the difference between the property's current fair market value and the amount the owner still owes on the mortgage. So it's the amount that the owner would receive after selling a property and paying any liens, also referred to as real property value. So when you own your home and you're paying your mortgage, that is your money that you're putting into your house. So when you go to sell that house, say the house is $300,000, you're selling it for $300,000. You have put $200,000 of equity. You've paid that much in your mortgage. So that is the money that you will be making back, essentially, and you have to pay the $100,000 off with the sale of the home.
Mm-hmm.
So you'll be making the $200,000 in the sale. So basically, it's just another way for you to make money, and your house is worth your own money. It's all yours.
Build wealth, for sure.
Yeah.
What we typically tell people is that equity is basically a comparison. So it's the amount that you actually own of your home versus how much that the bank owns. Mm-hmm. So every time you make a monthly payment, you're slowly chipping away at that principal balance that you originally borrowed. And every time you make a payment, you're putting a little bit more money essentially into your pocket. Obviously, for a lot of people, the goal would be to pay the mortgage off at some point. And then that way, as your home continues to appreciate in value, as homes have for the last 60 years, what you'll see is, when you go to sell the home, like Cecilia said, that's money that's going to come directly into your pocket because you don't have to pay the bank back for what you've borrowed. You've already kind of paid yourself back in by way of monthly payments.
So qualifying for a mortgage. So there are 6 factors that go into it, what we consider when reviewing your loan application. Those being your income, your total debts, your credit, obviously your employment history, the property itself, and the down payment, closing costs, and prepaids, cash reserves.
Mm-hmm.
So, Nick, do you want to go?
Yeah, I mean, one of the things that people don't realize, and this is kind of especially important in our area because there are so many different kinds of properties around, especially condos. So one thing people don't know is that condos actually come as a little bit of a higher risk to the lender and also to you as the borrower. You guys maybe remember, I think it was 2019, 2020, it was a few years ago, there was that really big condo complex in Miami that just completely collapsed out of nowhere. And it was just due to, poor maintenance, poor upkeep, and then the building itself was probably not constructed, as it should have been. But that's just a perfect example of why those kinds of properties are considered a little bit of a higher risk because, it's a larger building. You're connected to other people's homes as well. So, maybe your neighbor next door to you not doing their part to upkeep, their side of the property that can, because you're physically connected to them, you're kind of reliant upon not only your neighbors, but also, the property management company, whoever they're using to, maintenance the entire property. You're kind of subject to all of that. So because you're not a standalone unit, and you're not the sole person responsible for the upkeep of the property, that is one of the large reasons why condos in particular are seen as kind of a higher risk. So anytime you have a higher risk in a mortgage or any kind of lending, it's going to generally be a little bit pricier. So for mortgages, the way that your price can go up or down generally is by way of the interest rate. So what you'll typically see is even if you have perfect credit, you have a good amount of money saved, you have solid income, consistent income, a long employment history. If you were to go compare buying a condo to buying a single family home, you will get a very slightly higher interest rate on a condo as opposed to a single family home. It's not a deal breaker for most people. It's a very small amount, but it's something I like to make people aware of when they're shopping for homes. Condos come with their own kind of set of parameters, its own separate process. It's not any more difficult for you as the borrower necessarily to buy a condo. But again, it can be slightly more pricey just because of the nature of condos. Oh, that's weird. Maybe click it one more time. There we go. So to qualify for a mortgage, this is kind of general documentation rules. And we're going to kind of get into industry specific documentation in a little bit. But for those that are just straight salary, maybe you're a full-time W-2 employee, this is generally what you'll need when you go to reach out to a loan officer and get pre-qualified for a mortgage. So, generally I try to tell people, start gathering these things as you go to start having these conversations with a lender or with a real estate agent. You'll need pay stubs for the last 30 days, sometimes 60 days, usually just need 30 days. W-2s for the last 2 years is very standard. Personal and business tax returns, we'd only need business tax returns, obviously, if you own your own business. We usually don't even need personal tax returns, but there are instances in which we'll need to request them, just depending on what kind of income you have and how your income works. And then assets. So on top of verifying your credit via a credit report and verifying your income, we also need to take a look at the assets that you have, more or less the money that you've saved for the purchase of the home. So we don't need to see every dollar you've got, but we would need to see any accounts that you plan on using for your closing costs and your down payment. So that's what we will ask for your last 2 months of bank statements to show those assets you plan to use for closing.
So qualifying as a part-time or tipped employee, so obviously restaurant industry folks. So the tip income may be used if the borrower has received for the last 2 years. So if you've worked in the restaurant industry for 2 years or more, we can use that to qualify you. The income is an average of the 2-year period. So if you made a little bit less the first year, you made a little bit more the second year, we take an average of those two numbers to qualify you for your future income. The income trend is important. Income needs to be stable or increasing for over a 2-year history. So like I said, it's not that it would be an issue, but it's more so we would have to have a little bit more of a conversation.
Yeah.
If the income went down in your second or third year, we just need to understand what you've been doing. Maybe you picked up a class, maybe your life changes, we get it. So we just may need some more documentation. And then obviously document every dollar. If your employer doesn't do it for you, doesn't document your tips, make sure you do it. We like the app Server Life, just so that you can go in after you get your money at the end of the night or the next day, however your restaurant does it. You can just put it in there and it tracks it all for you. And that way we have a better idea of how you're getting paid, how much you're getting paid every day, weekly, monthly, all that good stuff.
Server Life is really good too, because you can actually see the trend that Cecilia, that we mentioned here. It's not necessarily an issue right off the bat if your income fluctuates up and down a lot. But what I will say is if you have a pretty steady history of declining income, so if you've decided in the last year that you want to just work fewer shifts, work-life balance isn't very important. Everybody's situation is different. But that being said, if you do have declining income, it can be harder to qualify for a mortgage, because part of the lender's job, part of our job, is to assess your ability to make payments, going forward. And declining income is obviously kind of a red flag for us. So I'm going to decline that. So that being said, if you're planning on buying a house in the next year or two, what I tell industry folks is, make sure that you are, continuing to work at least the same number of shifts that you've been working over the last year or two. If you can't increase the amount or increase the amount of money you're making. So debt to income ratio. This is something that a lot of people don't know exists until they start working with somebody, in the mortgage industry. But debt to income ratio is a large part of the picture. So essentially, debt to income it's a pretty straightforward calculation. Essentially, you just add up all of your total monthly debts, add in the proposed monthly payment for your new mortgage that you're applying for, and then you divide that by how much money you make monthly. So this is a monthly calculation. So what you do is you take the proposed monthly mortgage payment, which we have there, so principal and interest, taxes and insurance, and then if you have an HOA fee, that's also factored into your monthly payment, and then add in your monthly obligations on all of your other debts. So for credit cards, it's generally going to be the minimum monthly payment is the factor that we'll use. If you have student loan debt, general rule of thumb is take whatever your total balance is of all of your student loan debt, and then take 1% of that, and that 1% figure is your monthly obligation that we use for calculation. If you have, an auto loan, factor that in, obviously. Add all of that up, and then I think we've got the calculation next. All that, add it all up, divide it by your monthly income, and you get your debt to income ratio. So general rule of thumb, you want to try and stay under 45%. But there are many instances where we can get up to 50% of your total income being debt. Actually, in some instances on FHA loans in particular, you can even go above 50%. You'll have to have compensating factors like some money saved above and beyond your closing costs. But in a lot of instances, we can get up to 55 to 57% debt to income ratio. Not that we necessarily recommend maintaining over 50% from month to month, but again, everybody's situation is different. And if it gets you into a home and building equity and you have a plan to start paying some of that debt down, relatively quickly, we can qualify you for a home in many instances. So this is just a quick way for us to kind of go over what debt to income ratio is, and how you can calculate it on your own, so that those figures going into your conversations with any lender. This does play a factor into basically every single loan program out there, and honestly, the better your debt to income ratio, the lower that ratio is, the more favorable products you'll have available to you, the better interest rates you'll have. So just something to be aware of. We just wanted to kind of include the basics around some of the mortgage products that are out there. So a conventional loan is, you may have heard of Freddie Mac or Fannie Mae. They are what are called they're government agencies, basically, that put together the largest mortgage programs out there for the average American. So this is definitely, I would say, the most popular or the most used mortgage. It's very straightforward. It's kind of what most other mortgage programs are based around. So you'll see there the maximum loan to value is 97%. So what that means is you can put as little as 3% down in order to qualify for a conventional mortgage, only as a first-time home buyer. So if you've never bought a home, so long as you qualify for the programs, there are many instances where you can put as little as 3% of the purchase price down as your down payment. If you're not a first-time home buyer, or if you maybe don't qualify for those programs, the true minimum is 5% down. And then here's a quick look at some of the other government programs. So these, again, are very common. These are programs that almost every lender out there will offer. They're not exclusive to us at Univest by any means, but they help a lot of people get into homes. So just a quick look, FHA is great if you're a first-time home buyer or you have limited funds. So whereas conventional can be a little harder to qualify for if you have not so great credit, say your credit score is under 700, you can still qualify very much so. I think I know the minimum credit score for FHA is actually a 580. To be honest with you, it would be pretty difficult to qualify with a 580 credit score. But if you've got a 650 and you only have 3.5% down, FHA loans are a great way for you to get into a home while you continue to work towards raising that score or saving more money, whatever it may be. There's also way less limitations around FHA when compared to conventional loans. So I kind of mentioned earlier, you can go up to almost 57% debt to income ratio with an FHA loan, whereas on the conventional side, you have to be under 45 in most cases, or 50 at the absolute most. So again, for people that are struggling with debt situations, or maybe they just have a lot of student loan debt, maybe they don't fit into the little, the smaller boxes that the conventional loans force upon us. An FHA loan may be a great way for you to buy the same house that you were looking at. Again, all of these programs are, built to get people into homes. So, the government, especially in the last, I'd say 10 to 15 years, has put a big emphasis on first-time home buying and making it as accessible as it can be, for people in all different situations. A quick note just on the others. So USDA also has its own program. You'll see 100% LTV on both VA and USDA. So that means that in theory, you can put 0% down with both of these programs. USDA is a program that most of Delaware does qualify for. You'll see that it has to be in quote unquote a designated rural area that's defined by the USDA. Believe it or not, the entire state of Delaware is designated as a rural area by the USDA. So pretty much every property in the state qualifies under that program. But I will say that qualifying as a borrower for USDA can get a little tricky, especially if you have variable or part-time income. It's not looked very favorably, but if you're a salaried employee, it can be a great way to get into a home with very little money down. And then if there's any veterans out there, we also have VA loans, which are, again, you can put as little as 0% down. You could actually have 0% down and some of closing costs covered by the seller if you're a VA eligible veteran. So, and that's not actually just veterans as well. You can be active duty and have a VA loan as well. So just good to know there.
So the pre-approval letter, basically what happens is once we collect all of your documents and we have the conversation with you, you found a property and you want to put an offer in, you come to us, you let us know how much it is, we tell you what you can qualify for, and it confirms the aspects of your financial situation. So it determines that if you're qualified to buy a home and identifies how much home you can afford, like I just said, and it provides leverage when making an offer and demonstrates that you have been credit approved. So basically when you're working with a realtor and you decide that you want to buy a home, you let them know. They ask you if you've spoken to a lender. If not, they send you to their lender of whoever they recommend. You get pre-approved, and that pre-approval letter is just the stamp of approval, and it just shows that you're a more qualified buyer than somebody going in and making a blind offer saying, oh, I can afford this, but not they haven't talked to a lender. They don't know 100% for sure. So really it just shows that you are a qualified borrower, that if the offer is accepted or when the offer is accepted, it will be able to go through. And it just gives the selling agent and the sellers more confidence in selling to you and accepting your offer.
If you go in to submit, an offer with your real estate agent, and in that offer letter, your pre-approval letter from a lender is included in it, that'll just make the other side of the transaction feel a little bit better about how serious you're taking the process. And that way they can see that you've done the work to, know that you can qualify for whatever that offer is that you've decided to put out there.
And last,
we'll take you through just really quickly. So we just kind of talked about the pre-qualification, pre-approval process. With pre-qual and pre-approval, these words are kind of used interchangeably depending on who you talk to. Real estate agents or other lenders alike will use them in different situations. The way we define it, a pre-qualification basically means that you submit an application to us, we pull your credit report, we get some of that basic documentation like your W-2s, your pay stubs, and then we do our reviews. So that's part of our job, in our day-to-day life, is we take a look at all of these documents that people provide to us along with their application, and then use the knowledge and skills that we have to say, okay, based on what you've given us and what you've told us, this loan program seems like it would be the best fit for you. Here's what your payment would be. Here's how much you need to bring for your down payment and closing costs. And then issue you a pre-qualification letter. Pre-approval, on the other hand, means that we actually submit you to an underwriter. An underwriter is basically the person that at the end of the day is actually making the determination on your qualification. So while we as the loan officers say, yeah, we know the guidelines and we can see what you've provided to us, we feel pretty confident that you would qualify for X amount loan. The underwriter is actually the person that makes that decision. Final decision, one way or the other. They're qualified, they're not qualified. Excuse me. So pre-approval, we actually take that extra step. Usually with most lenders, what you'll do is you'll get pre-qualified, you'll go submit an offer, then you're under contract, but you've never actually had your file looked at by an underwriter who at the end of the day, again, is the one making the decision. So what we can do is get you in front of an underwriter. It's just an added level of confidence that, the lender has taken every step possible to review everything you've given us. And we can say very confidently, not only have we looked at it, the underwriter has looked at it and also given you that stamp of pre-approval. Once your offer is accepted, then you go into the actual application stage. Once we have the specific property address, again, like we mentioned, the property does play a factor. It plays a role in the whole process. It plays a role in your pricing, in the program. And so once we have an actual ratified contract, that's when we can take a look at the property details, the specifics around the property, make your application and get you into the process. So that's when we'll get you into opening. We would order the appraisal. So the appraisal is quick overview on appraisal. Appraisal basically means we send an appraiser who's an expert on determining the value of properties. They go and look at the house that you're trying to buy and do a full inspection and then make an assessment based on their expertise that says, the home is worth this much. The appraiser plays a really important part of the process because their valuation is what we use to determine, how much we can lend on the property. So appraisal comes in. If they say the home is worth what you're offering, great news. We keep it moving into the next process, which is, continuing to do a review. Your loan processor will look at all the documents, look at the appraisal, everything else, to get it into underwriting, as we talked about. So underwriter will then look at all of the things that we've gathered from the appraisal, all of your documentation, the tax things that go into it, title work, and then make a determination if you're approved or not. Hopefully, if you've gotten this far through the process, it's likely that you will be approved. And then once you're approved, you go to closing, you bring your cash to close like we talked about, you sign your paperwork, and you get the keys to your home. And that's basically a loan process in a nutshell. So that is our presentation. If you guys have any questions, open to answer any right now. Of course, we know that this is kind of a very personal process for many people. So if you are, you don't want to ask any kind of specific questions right now, totally understand. Just feel free to reach out to us directly, and we're happy to talk about, anything that you may have questions on.